Hello, this is Jeff Hildebrand for TBL Traders. Today we're going to look at technical analysis, keeping in mind options trading and option strategies. There are a few things to know, and we're going to start off with the basics. Technical analysis or chart analysis, whether you're looking to trade options or stocks, are the same. The advantage of using options and applying those options to your technical or chart analysis is that you can apply strategies that are either long, short, or neutral. Those are the basic strategies. You can also eventually, as you move on, apply more complex strategies such as volatility strategies or time strategies. You can set up synthetic positions, boxes, hedges. There's literally hundreds of possibilities. It's a complex field. Read some books, search the web, speak to experts in the area. There are literally hundreds of possibilities. So for the moment, I'm going to look at two examples. Before I forget, one other comment. Learn the Greeks so that you understand how options are priced. There's literally no reason to buy or take risk with options if you don't understand how they work and how the basic pricing of options work. Again, we're going to look at two strategies. We're going to look at two stocks, two underlying, and we're going to look at those strategies, long, short, and neutral. For Twitter, we're going to look at some range-bound or neutral strategies. We're going to look quickly at the butterfly or iron condor, which are two strategy examples. For Netflix, we're going to look at a long strategy and a short strategy in case you want to set up a reversal. Okay, let's start with Twitter. Let's start with Twitter. Why are we starting with Twitter? Because Twitter has a range-bound stock. Twitter's a range-bound stock at the moment. It is range-bound between 30 and 34, 30 and 35, you could say. So I'm going to look at this chart and say it's neutral. There's no obvious trend here. And when I look at the inflection points, I see 30, 31. There's some resistance at 33 and some resistance up around 35. One strategy here is the butterfly. The other is the iron condor. I'll give you an idea of how they look and how they work quickly. The butterfly, for example, this butterfly is a 31, 33, 35 butterfly. I'm selling 33s, twice as many 33s. I'm buying 31s and I'm buying 35s. You can see the setup here. My max profit will be $1,500. My max loss will be $450. I've decided to choose the 33 level range here as the center, arbitrarily almost. It could just as well be the 32 as the center and your profit would change a little, but just for the example I've chosen the 33. Again, here's the profit and loss chart. 33 was your max profit, 31 max, anything under 31 or over 35 is your max loss, and your break evens are between 31.50 and 34.50 roughly. So now let's look at the iron condor so you can see the difference. Okay, an iron condor 34, 33, 34, 35, 36 would look something like this. What this means is I'm selling 34, 35, the inside range, and I'm buying the outside range, 33, 36. Max profit will be $800, max loss will be $200. So you see the difference between the butterfly and the iron condor. Your max profit will be much less and your max loss will be much less because you are predicting or saying that range is going to be between, when expiration arrives, in this case it was 34, 35, that range is going to be here. Okay, you can spread the iron condor out over this entire range if you want. That's also possible. Again, your max profit and max loss will be reduced, but keep in mind you can change the quantity easily if you want to take more or less risk on these trades. Now let's have a look at Netflix and make a directional choice or apply a directional strategy to our chart. Netflix, I'm going to take the more complicated example first to give you an idea. Why? Because there is one other interesting point about this chart. You have a divergence between the upward channel, which I've specified here, and a downward sloping volume. So that's a divergence which I find interesting, which starts to speak to a reversal. How would we trade a reversal? The reversal, because you're at the lower end of this range, I wouldn't trade a reversal till you get here or higher. So let's say 435. If you break 35, I would wait till 440 or 450, more like 450. If you don't break 435, you could start to look 430. In that case, you're going to look for trades which you profit on a downturn. You could buy puts directly, or you could buy a spread which will protect the lower end of your range. In this case, we're going to buy a put spread 435 430. Sorry, 435 405. You can see the ranges I've chosen. I've just set the window at the bottom of it, 400, 405, because I'm saying, hey, it's going to break out here and fall to 405, and that's where I want to be. That's where I want to get out, basically. But I'm going to wait for this trade to move up to 435. I'm going to wait for it to move up here before I make that trade, and that's what the chart's going to look like. Now let's look at the reverse, where we believe we're going to follow the channel up. Okay, in this case, I'm going to apply a bull strategy, and I'm going to make this is going to be a bull spread. This is basically a reversal of what we saw last time, but I'm going to follow the channel we saw earlier. Here I'm going to buy 425s and sell 445s with a max profit of 11,000 and a max loss of about 8,000, with a break even around 433. That is about where we are today. If I believe it's going to follow that channel up, I would put on this trade. If I believe it's going to be a reversal, I would put on the trade that I showed you before. The risk with this trade, again, is that this divergence here is signaling that this upward trend is slowing down. Anyways, those are two examples for you. Thanks again for listening to the video, and take care.